Welcome to the Property Wealth Podcast. We're so glad you're joining us today for what promises to be an insightful discussion.
Absolutely, Sarah.
So have you ever heard of Delaware Statutory Trusts, or DSTs?
Yeah, they're gaining a lot of attention lately.
Right? They can be a great way for investors, especially those over 40, to diversify their portfolios and manage their tax liabilities.
Exactly, and they can be particularly appealing for those looking to step back from the day-to-day management of properties.
Today, we'll dive into what DSTs are, how they work, and the benefits they can offer for long-term wealth building.
Plus, we'll talk about how they fit into the broader landscape of real estate investing and what to consider before jumping in.
Sounds like a plan.
Yeah, so let's get started.
First off, Mike, can you break down what a Delaware Statutory Trust actually is?
Sure. A DST is a legal entity that allows multiple investors to pool their funds to invest in real estate. It's structured to provide certain tax benefits and can be a more passive way to invest in property.
That's interesting. So it's not just about the property itself, but also about the way it's structured?
Exactly. The structure is key. It can help investors defer capital gains taxes and provide a steady income stream.
Wow, that sounds really appealing. Let's dig a little deeper into the advantages of using a DST for real estate investing.
So, thinking about why Delaware Statutory Trusts, or DSTs, matter right now, especially for our listeners over 40, it's really about timing, right?
Absolutely. As we age, our financial priorities often shift. We start thinking more about retirement and how we want to secure our future and that of our families.
Exactly. And with the uncertainty in the market, inflation creeping up, a lot of people are feeling that pinch. It's like, how do we protect our wealth while also thinking about growth?
Right. I've spoken to several folks who are concerned about their retirement timelines and, how to make their money work harder for them.
That's a big one. I remember this investor, let's call him Tom. He's in his late 50s and was worried about his 401k taking a hit during the recent market fluctuations. He started exploring DSTs as a way to diversify his portfolio.
And that's a smart move, right? Because DSTs can provide that steady income stream, especially when traditional investments seem risky.
Definitely. Tom found that DSTs offer a way to invest in real estate without the hassles of direct property ownership, like maintenance or tenant issues.
Yeah, and that's huge for someone approaching retirement. No one wants the added stress of managing a property when they should be enjoying their golden years.
Exactly. And when you think about the emotional side of financial security, it's not just about numbers. It's about peace of mind.
For sure. Imagine waking up knowing that your investments are working for you, generating passive income, while you can focus on what really matters in life, like family, travel, or hobbies.
That's the dream, right? And for families looking at wealth transfer, DSTs can play a significant role there too.
Right. Like, let's say someone has a portfolio of properties they want to pass down to their kids, but managing all that can be overwhelming for the next generation.
Exactly. With DSTs, you can simplify that process. You set up the investment, and it continues to generate income for your family without them having to dive into the nitty-gritty of property management.
I love that. It's like leaving a legacy that doesn't come with added stress.
And, inflation is a real concern these days. Real estate generally holds its value over time, so investing in DSTs can act as a hedge against inflation.
Yes. I've heard stories from investors who've seen their returns keep pace with or even exceed inflation rates.
Right. One investor, let's call her Linda, was worried about the rising costs of living. She invested in a DST and found that not only was she getting consistent returns, but her investment was also appreciating.
That's a win-win, and it's especially important for those over 40, as they're often looking to solidify their financial futures and ensure they have enough for retirement.
Exactly, and it's about being proactive. The earlier you start thinking about these strategies, the more options you have.
And speaking of options, I think a lot of people over 40 might feel stuck. Like they've done things a certain way for years and aren't sure how to pivot.
That's a common feeling. But really, it's about adapting to the current economic climate. Just because something worked in the past doesn't mean it's still the best strategy today.
Right. The world is changing, and so should our strategies. I mean, look at how technology has changed the way we invest.
Absolutely. And DSTs are a perfect example of that innovation in real estate investment. They offer a way to access high-quality assets that many of us wouldn't typically be able to invest in on our own.
That's a great point. It democratizes real estate investment, making it more accessible for those of us who might not have millions to spend.
Exactly. It's about taking advantage of the opportunities out there. Especially when the market is shifting, you want to be in a position to adapt and thrive.
And for those with a longer timeline before retirement, it's also about compounding returns. Investing in a DST can lead to significant growth over time.
Right, and that's something people often overlook. They think short term, but real estate is usually a long game.
Yes. So even if you're in your 40s or 50s, investing in a DST can set you up for a much more comfortable retirement just by letting that investment grow.
And, it's also about the tax advantages. Many investors don't realize the potential tax benefits of investing in a DST, especially if you're looking to defer capital gains taxes.
That's a huge one. You can reinvest those savings into other opportunities, which can really accelerate wealth building.
Absolutely. And for anyone feeling overwhelmed by the thought of real estate investing, DSTs can be a simpler way to get started.
I totally agree. They provide an entry point without the stress of direct ownership, which is appealing for many.
And it's comforting to know there are options that fit different lifestyles and needs, especially as we all navigate these uncertain times.
Exactly. It's not just about making money. It's about creating a secure future for ourselves and our families.
Well said. So as we transition into discussing specific strategies related to DSTs, it's really important for our listeners to understand how to make the most out of this investment vehicle. So let's dive into some core strategies and rules of thumb when it comes to real estate investing, especially with Delaware Statutory Trusts, or DSTs.
Absolutely. I think one of the first things folks should consider is the 1% rule, right?
Yeah, exactly. The 1% rule is a great starting point for evaluating potential investment properties. It suggests that the monthly rent should be at least 1% of the purchase price. So if you're looking at a property that costs, say, $200,000, you'd want to see it generating about $2,000 a month in rent.
Right. And that helps ensure you're covering your mortgage and expenses, doesn't it?
It does, and it gives you a quick snapshot of whether a property could be a good investment. But, it's important to dig deeper. Just because a property meets the 1% rule doesn't mean it's the best choice, right?
Exactly. There are other factors to consider, like location, condition of the property, and potential appreciation.
Speaking of location, that brings us to the 50% rule, which is another handy guideline. This rule suggests that you should budget about 50% of your rental income for operating expenses.
So if we stick with our $2,000 monthly rent example, you'd set aside about $1,000 for expenses.
Yep, exactly. That includes property management, maintenance, insurance, and, other costs. It's a good way to gauge your cash flow.
And if you find that your expenses are significantly lower or higher than that, it might be a sign to investigate further.
For sure. And then there's the cap rate, or capitalization rate, which is another crucial metric. The cap rate helps you evaluate the potential return on an investment property.
So how do you calculate that?
It's pretty straightforward. You take the net operating income, which is your rental income minus your operating expenses, and divide that by the property's purchase price. Let's say you have a property that generates $24,000 a year in rent, and your expenses come to $12,000. Your net operating income would be $12,000. If you bought the property for $200,000, your cap rate would be $12,000 divided by $200,000, which is 0.06 or 6%.
That's a solid return, right?
Yeah, a 6% cap rate can be considered a decent return. Depending on the market, higher cap rates usually indicate a better return on investment, but might come with more risk, while lower cap rates mean lower risk but potentially lower returns.
It's all about balancing that risk and reward, isn't it?
Exactly. And another consideration is the deal evaluation checklist. Having a checklist ensures you don't overlook important factors.
What should be on that checklist?
Well, it could include things like property condition, neighborhood demographics, vacancy rates, and comparable sales in the area. Also, check local market trends. Are prices going up or down?
That's a good point. It's so important to stay informed about the area you're investing in.
Absolutely. And then there's financing options, which can often be a bit daunting for new investors.
Right, so how do you suggest they approach that?
Start by looking at your financing options, like conventional loans, FHA loans, or even private money lenders. Each has its pros and cons. For example, FHA loans might have lower down payment requirements, but they come with stricter guidelines.
And private money lenders can be more flexible, but they might charge higher interest rates, right?
Exactly. It's all about finding what works best for your situation. Also, don't forget about the impact of interest rates on your overall investment. A slight difference in rates can significantly affect your cash flow.
Yeah, I think it's crucial to run the numbers and see how different financing options play out for your specific investment.
Definitely. And then you have to consider the types of properties that fit well within a DST structure.
Like what?
Well, DSTs typically invest in larger commercial properties like apartment buildings, retail spaces, or even industrial properties. They provide investors with access to a diversified portfolio without the hassles of direct property management.
And that can be appealing, especially for those who might not want to deal with the day-to-day management of a rental property.
Exactly. Plus, DSTs allow for fractional ownership, so you can invest in properties that you might not be able to afford on your own.
That's a great way to spread your risk, isn't it?
Absolutely. And speaking of risk, it's important to keep in mind that every investment comes with its own set of risks.
Right, and that leads us into some common pitfalls to avoid in real estate investing.
Exactly. Let's talk about that next. One of the most common pitfalls I see with Delaware Statutory Trusts, or DSTs, is over-leveraging.
Oh, for sure. I mean, it's so tempting to think you can maximize your returns by borrowing more. But, wow, that can really backfire, right?
Exactly. I had a client once who was so excited about a specific DST investment. He thought, if I leverage this property, I can double my returns. But he didn't account for potential market fluctuations.
That sounds risky. What happened?
Well, unfortunately, the market dipped right after he invested. His cash flow was affected, and suddenly he was stretched thin with his mortgage payments. It became a real struggle for him.
Yikes! That's a tough lesson. So how can someone avoid that kind of situation?
A good rule of thumb is to never over-leverage beyond what you can comfortably handle. Look at your overall financial situation and ensure that you have a buffer for unexpected expenses or market downturns.
That makes sense. And speaking of unexpected expenses, let's talk about bad tenants. I mean, finding the right tenants is crucial, right?
Absolutely. I once had a client who didn't do a thorough background check on a tenant. They were just eager to fill the space,
And I'm guessing it didn't end well?
Not at all. The tenant turned out to be a nightmare. Late on rent, damaging the property. I mean, it cost my client thousands in repairs and lost rent.
Oof, that's painful. So what should investors do to screen tenants more effectively?
Well, first off, I recommend thorough background checks, including credit history, rental history, and even speaking with previous landlords. And trust your gut. If something feels off, it probably is.
Right. Intuition can be a powerful tool. Now, what about cash flow? I've heard some investors neglect that aspect, too.
Yes, cash flow is critical. I had another client who focused solely on appreciation potential in a property, thinking it would skyrocket in value. But they didn't pay attention to the cash flow.
That can lead to some serious issues.
Exactly. When expenses started piling up, like maintenance and property taxes, they quickly realized they were in the red each month. It's like driving a car on empty, hoping to make it to the next gas station.
So what should investors be looking for in terms of cash flow?
They need to ensure the property generates positive cash flow from day one. Calculate all expenses, mortgage, taxes, insurance, maintenance, and make sure the rents cover that comfortably.
Got it. And then there's the infamous timing the market. I mean, it's a gamble, isn't it?
It really is. I've seen investors wait for the perfect moment to jump in. One client held off for years, convinced that prices would drop, but they never did.
That's frustrating. So what happened to them?
Well, they ended up paying significantly more when they finally decided to invest. The lesson here is to focus on your individual strategy and goals rather than trying to predict the market.
That's so true. And then we have to consider hidden costs too. Those can really sneak up on you.
Absolutely. I had an investor who was focused on the initial purchase price of a DST, but completely overlooked the ongoing fees. Management fees, maintenance reserves, legal fees.
Those can add up quickly, right?
They really can. In the end, his returns were much lower than expected because those hidden costs ate into his profits. It's crucial to read the fine print and understand what you're truly getting into.
So it sounds like doing your homework is key.
Definitely. And, it's also important to stay connected with your investment. Regularly reviewing the performance and staying informed about market conditions can help spot red flags early.
That's a great point. So if someone finds themselves in a tricky situation due to these pitfalls, what steps can they take to recover or avoid future issues?
First, they need to assess their current situation honestly. If they're over-leveraged, maybe it's time to adjust their portfolio, even if it means selling an asset.
And for those with bad tenants?
Well, they should look into eviction quickly if necessary, but also learn from the experience. Reevaluate their tenant screening process to ensure it's thorough next time.
That's sound advice. And for cash flow issues, I guess it's all about reevaluating expenses and perhaps even raising rent if the market allows.
Exactly. And they should also consider diversifying their investments to mitigate risk.
Right. Spreading the risk can be a smart strategy. How about timing the market? What can someone do differently next time?
Instead of trying to time it, they should focus on long-term strategies. Buy properties that fit their goals, regardless of market fluctuations.
And finally, for hidden costs. What's the best course of action?
Always read the full disclosure documents and consider working with a knowledgeable advisor who can help identify those hidden costs up front.
Sounds like a solid plan, Mike. With these insights, I think our listeners can navigate these pitfalls much more effectively.
Absolutely. It's all about being informed and proactive.
So let's wrap up this section and transition into next steps for our listeners.
So, now that we've talked about Delaware Statutory Trusts, let's dive into some immediate steps people can take, right?
Absolutely. I think the first thing is to get familiar with the concept, so maybe start with a solid book on real estate investing.
Yeah, a great starting point is the book on rental property investing by Brandon Turner. It really lays out the fundamentals in a way that's easy to understand.
That's a good one. And if they want something focused specifically on DSTs, the Delaware Statutory Trust Handbook by John W. Hennessy could be really useful.
Right. And, podcasts can be a fantastic way to absorb information, too. The Bigger Pockets podcast has some episodes that touch on DSTs and other real estate strategies.
Yes! And I love how they break down real-life scenarios, which makes it relatable.
Exactly. And, there are tools and apps that can make the whole process easier. For instance, Zillow is great for researching property values and market trends.
Oh, definitely. And if you're looking at investment properties, you might want to check out the Bigger Pockets calculator. It helps you analyze deals and estimate cash flow.
Another good option is Deal Check, which is similar but offers a more visual interface so you can really see the numbers work out.
Right. And don't forget Rentometer. It's super handy for checking rental rates in specific areas.
Yeah, and having access to your local MLS can give you a leg up. You can see what properties are actually selling for, not just the listings.
That's key. And, even if you're just starting, it's helpful to get into the habit of analyzing one deal per week.
For sure, that practice can really sharpen your skills. It doesn't have to be a big deal. Even just looking at a few numbers can get you comfortable with the process.
And joining a local real estate meetup can be a game changer. Meeting people face-to-face and hearing their experiences can provide so much insight.
Absolutely. Networking with others can lead to opportunities you might not find on your own.
Plus, there's so much to learn from others, successes, and mistakes.
And if you're looking for mentorship, many meetups offer that too. You can find someone who's been through the trenches, so to speak.
Yeah, that's invaluable. And don't forget, starting small is perfectly fine. Just take those first steps at your own pace.
Exactly. Even if it feels overwhelming at first, just remember to break it down into manageable pieces.
Right. You don't have to make huge investments right away. Start with what you're comfortable with and build from there.
And keeping a journal of your learning and experiences can be really beneficial. It helps you track your progress and reflect on what you've learned.
That's a great idea. It's encouraging to see how far you've come over time.
Plus, it allows you to clarify your thoughts and maybe even spot patterns in your investment choices.
So true. And speaking of clarity, having a clear investment strategy is crucial.
Definitely. Think about what your goals are. Do you want passive income, long-term appreciation, or something else?
Yeah, and setting those goals can help guide your decisions moving forward.
And remember, it's okay if those goals evolve as you learn more about the market and your own preferences.
Exactly. The important thing is to stay flexible and open to new opportunities while being strategic.
So, with all these tools and habits in mind, it's time to take action. You've got everything you need to start exploring.
It's all about taking those first steps. You're not alone in this journey. The community is out there waiting for you.
And you know what? With these tools in your pocket, you're ready to move forward.
So let's recap what we've covered today.
Well, Sarah, as we wrap up our discussion on Delaware Statutory Trusts, I think it's important to highlight a few key takeaways for our listeners.
Absolutely, Mike. So first off, I'd say one of the biggest points is that DSTs allow investors to diversify their portfolios without the hassle of direct property management, right?
Yeah, exactly. It's like having a piece of the pie without having to deal with the whole bakery. And then there's the tax benefits, which can be a real game changer for those looking to defer capital gains taxes.
Right. That 1031 exchange option can really help investors maximize their returns. Not to mention the potential for steady cash flow from these properties.
And let's not forget about the access to larger institutional-grade properties that individual investors might not be able to take on by themselves. It opens up a whole new world for folks looking to invest.
Definitely. And I love how DSTs can be a perfect fit for those over 40 who might be thinking about retirement or just looking to build that long-term wealth strategy.
Yeah, it's all about creating a sustainable income stream for the future. Real estate can be such a powerful tool in achieving that.
So to all our listeners, remember that building wealth through real estate is a journey, and it's never too late to start.
Absolutely. Whether you're considering DSTs or other avenues, just take that first step.
And if you enjoyed today's episode, don't forget to like, subscribe, and comment below with your biggest takeaway or any questions you might have.
And if you know someone over 40 who's looking to invest in property, share this episode with them.
Oh, and don't miss our next episode where we'll dive into real estate notes, buying mortgage notes.
That's going to be an exciting topic.
Thanks for joining us today, everyone.
Take care and happy investing.
Bye for now.